Hi everyone. In today's video, we'll be looking at my top 3 favorite momentum indicators. So if you are new to this channel or new to the concept of momentum, I'll just take a couple of minutes to explain what is momentum. Momentum is the quantity of motion that is left in an object. So when we apply this concept of momentum to stock prices, it refers to the quantity of the strength that is left to take the stock in the same direction. So when we say direction, the stock could be either moving in the upward direction or in the downward direction or in the sideways direction. So momentum is a vector, like it can be used to measure how much more strength is left in a stock price so that it continues to move in the same direction, that it continues to move in the upward direction or it continues to move in the downward direction. So this can be used to measure the strength as well as the direction as well. So it's a vector quantity, so it has both magnitude as well as direction. So let's look at the first indicator, which is the rate of change indicator. Like the name says, rate of change indicator is used to measure the rate at which the price is changing, because we are using price as the quantity to measure the momentum. So we are going to measure at what rate this price is changing. So to calculate ROC, it's a pretty straightforward calculation. We take the current price and we take the price n days ago and divided by the price n periods ago times 100. So this n could be anything, like it could be 1 month or 2 months or even 3 months. It basically defines the look back period, like how far back you want to go back and take that price and measure how far it has changed, that is how far the price has changed over this look back period. Now the advantages of ROC is that it is a pretty straightforward calculation. It is a pretty simple and straightforward. So if you're going to implement this indicator in any of your coding package, like in Python or Google Sheets or any of your trading packages, it is pretty straightforward to calculate. But in most of the trading softwares, it is readily available as an indicator, so it's pretty easy to use it. And it also gives you a clear view of the acceleration. So when the rate of change is positive, we know that the price is accelerating in the upward direction, or the stock is moving in the upward direction. When the ROC value is negative and it is very large, it means that the price is moving in the downward direction at a fast rate. So the same applies to the upward direction. When the ROC value is high and positive, it means it is accelerating in the upward direction fast. The disadvantage of ROC is that it can be very sensitive to sudden price hikes, like very volatile stocks. When there is some quarterly results and the stock price suddenly jumps up, then the stock price will have a sudden increase in the rate of change value, because the price has quickly changed when there is a gap up, or like there's an earnings update and the stock gaps up a lot, like a 10% or 5%, then there can be a sudden increase that we call this sensitiveness. So ROC is very sensitive to sudden price increases. So why does this matter is that, so when you are having a system that uses this rate of change to generate the signals, so you will have frequent buys and sells when the indicator is very sensitive. So you will have stocks that are entering your portfolio and exiting your portfolio very quickly. So that might result in a lot of churn, and that might frequent churn increases your transaction cost. So that's why we call this sensitiveness to sudden pricing as a disadvantage. Now let us go to the second indicator, which is the relative strength index. Now, like the ROC, RSI is also very straightforward. Now, like we can use the look back period, like the typical look back period is 14 days. So during this look back period, we determine how much is the average gain and how much is the average loss. Divide average gain over n periods and divide the average loss over n periods, and we calculate the RSI, the relative strength index. Just like ROC, it's also pretty straightforward. Now coming to the advantage of RSI is that it is also pretty straightforward to calculate and understand the formula, and it's also very easy to interpret. Now when the RSI value is above 70, it means that it is overbought, and when the RSI value is less than 30, it means that it is oversold. The disadvantage is that it can be slightly lagging in very highly volatile market conditions. So it is a slightly lagging indicator. It is opposite of ROC, it's which is very sensitive, but this is like slightly lagging in highly volatile market conditions. That is the disadvantage of relative strength index. Now, though it is very easy to interpret these values, the typical interpretation or how beginners view these interpretation is very wrong. So I'll explain that in the next section. So the misleading interpretation is that when we say that the RSI value is greater than or equal to 70, the typical term that is used to refer to it is overbought. Now, when we use terms like overbought and oversold, beginners think that overbought means it can't go any higher, and oversold means they assume that the stock cannot go any lower. Now, this is a very wrong interpretation of overbought and oversold terms. Now, I'll explain first with overbought example. Now, why is a stock overbought? Why is the market participants paying a premium for a particular stock price? People are market participants like big investors or even retail investors are paying a premium because the markets are always forward looking and are discounting machines. We are trying to discount the future cash flows in today's price. So that's the reason why good stocks like blue chip stocks and premium stocks always trade at a premium, or they trade always or most of the cases in the overbought zone. Like take the example of Nvidia, Apple or Amazon during its prime days. It always used to trade above, like it always used to be in the overbought situation, because the market participants are willing to pay a premium to discount the future cash flows in today's price. So overbought doesn't mean that the stock cannot go any higher. We have seen that Nvidia, Apple, Amazon, they have continued to scale newer highs and have continued to remain in the overbought situation because there are more investors' money entering these particular stocks. So the typical interpretation of overbought, that it cannot go any higher, is very wrong. And especially beginners, even when I was a beginner, I used to think that overbought means the stock cannot go any higher and and usually beginners try to short these particular stocks, which is a very wrong decision to make. And similar interpretation of oversold means that the stock cannot go any lower. So usually beginners try to buy oversold stocks thinking that these stocks might turn around and start moving in the upward direction. But it might happen in one or two situations where the stocks oversold and then turns back and trend reverses. But in most of the cases, the stocks continues to make lower highs and lower lows, and a stock can go up to zero. In most of the cases, this is what usually happens. So the typical interpretation of oversold, that it cannot go any lower, is a very wrong interpretation. And beginners usually think that oversold means it cannot go any lower, and then they try to buy it and try to look for a lower turnaround. You will have to have a lot of patience, and in most cases your patience will be tested, and in most cases the stock will never turn around, and you will be only maximizing your loss. It has happened with me when I was a beginner. So this typical interpretation is very wrong. So hope you learned something new from this video. Now moving on to the third indicator, my favorite indicator. Third indicator is commodity channel index. Now to calculate CCI, this is a formula that is used, the typical price, which is an average of the high, low and close price, minus the simple moving average of the typical price, and we use a constant 0.015 times the mean deviation. Now the general interpretation of CCI is that once it crosses plus above 100, it means that it is overbought, and if it crosses below minus 100, it means that it is oversold. Now the typical interpretation or general interpretation of, from beginners especially, it is quite misleading. And these indicators are also readily available in software packages. You don't need to know these formulas unless you are trying to implement them in your coding packages. But even in some of the technical libraries like in Python, these of the indicators have been already been are already available as a package or library that you can readily use. So it's just for your information that I've shared how these values or technical analysis indicators are actually calculated. Now, CCI measures how far is the deviation of the current price from its average price. So when we see that the current price is deviating away from the average price in towards the upper bound, like in the Bollinger Band, we know that there are smart money in entering, or somebody is trying to enter the stock and try to push the price in the upward direction. Now, if it is in away from the average price in the downward, like in the lower band, it means that the stock is, or the investors are exiting, and that is the selling pressure is high. That's the reason why the stock price is deviating from the average price in the bottom direction. Now, the advantage of CCI is also that it is very easy to calculate and it's a readily available package. And it is also like can identify both the trend as well as the momentum. Trend, if it is positive, it means that it's an uptrend. If it is negative, it means that it is in a downtrend. The disadvantage is that it is also like rate of change. It is very sensitive to sudden price changes, just like ROC. So when you are developing a trading system or trading rules based on CCI, it will result in frequent transactions or frequent churn. So to handle that, like I said earlier, you need to have a smoothing to smooth out the values. Now, apart from ROC, RSI and CCI, there are several other momentum indicators like MACD, ADS, average directional index. Now, the important thing to note is that all of them are measuring this same quantity. Now, if what some beginners do is that they think that if they had more technical analysis indicators, they will have more accuracy in predicting the direction or predicting the stock direction move, which is wrong, because at the end of the day, all these indicators are measuring the same quantity. Now, so you need to have only one particular indicator to measure one particular quantity attribute. So if you're measuring trend, you need only one indicator to measure your trend. If you are if you're measuring momentum, you just need one indicator to measure the momentum. So in today's video, we looked at my favorite top 3 momentum indicators. In some of my systems, I use most of my systems are based on rate of change, because it is pretty easy to use and calculate and generate signals based on ROC. And in some of the short-term trades, I also use CCI indicator to filter out, like scan for stocks that are showing very strong momentum. Like I look for stocks that are having CCI above 100, positive 100 value. Thank you for watching this video. Hope you learned something new. And if you learned something new, please do consider subscribing to this channel and also share it with your friends and if you found some value. Thank you.